The Rebel Capitalist Show.
You know, one thing I wanted to, a quick story I wanted to tell you, Brent, that really illustrates kind of your whole theory, I think. And for Americans, I know sometimes it's tough to kind of get their head around because it's all relative, and we see all the high rates of consumer price inflation here and huge negative real yields when you compare the CPI with the 10-year and, you know, the dollar depreciating against all the stuff that you're buying daily. So in Rebel Capitalist Pro, which Brent is one of our pros there, as you know, we do live streams, and I do them once a week where the pros or the members ask us questions directly. And we've got a member from Turkey, and they asked me a specific question. That basically the question was, what do I do? Right? You know, you always get that question. But they gave me all of the headline numbers from Turkey before they kind of asked the main question. And it just, I had never thought of it, or I'd never seen it through that lens. And so what they said is, they said, listen, the Fed funds rate, or their central bank rate, you know, their overnight rate, 14%. Okay. Their 10-year bond, I think, was trading roughly 20%, something like that.
Yeah.
Okay.
Yep.
Their official headline CPI was 60%.
60. Yeah.
And they said, in reality, it's closer to 150%.
Yeah.
And so then they said, okay, well, what do I do? And oh, by the way, real estate has skyrocketed, even in dollar terms, you know.
Yeah.
And so it's not like that's cheap to, you know, a safe haven for your money. And
Their stock market too. Their stock market has been going up.
Yeah, but you're still losing purchasing power.
Yeah,
they gave me that number too, and that's still
Yep.
less than the rate of inflation. Gold, you did okay. And so, you know, I thought about it. I'm like, you got to buy dollars. like that's it. You got to buy dollar, or you got to buy treasuries. You got to buy gold dollars or some sort of dollar denominated asset. And it just kind of dawns on you that, oh, okay, I get it now. And then you look at what Japan is going through, where, I mean, you could give me the details on what the yen has done. It's just absolutely fallen out of bed. But it's the same thing. If you're a pension fund in Japan, what do? And another thing I want to highlight, and then I'll let you kind of riff on that, is as Americans, we have to understand that Japanese don't buy stuff denominated in dollars. They do, but not the consumers, right? Their stuff is denominated in yen. So they don't care what the CPI is in the United States. That is irrelevant to them. What they care about is the cross rate between dollars and yen. And if the dollar is going up against the yen, even if it's going down significantly against consumer goods and services in the United States, they're still increasing their purchasing power. So do you want to buy a 10-year Japanese, a JGB at what, 0.25%? Or would you rather get a 10-year treasury that's not only paying you 3%, but also where the dollars that treasury is denominated in are appreciating in value against the stuff that you're buying daily? And so I know I'm kind of preaching to the choir here, but what insights would you add on top of that?
Well, I just think that's the point that I'm glad you're making that point, because, you know, it's a big world, and it drives me crazy when these people, they just focus on the US and they say, you know, the US inflation rate is this, and the US deficit is this, and the US interest expense is this. And the people that are saying this, they have no idea what the interest expense is in Japan. They have no idea what the interest expense is in Europe. They have no idea what the entitlement payments are over there. And those, and the demographic problems of these other regions. And it's a big world, and capital can flow kind of wherever it's best appreciated. Now, capital controls are going to start to go up in the years ahead. That's, you know, we haven't had a lot of capital controls for the last 10 years. I think we're going to see a lot over the next 10 years because capital will be flowing around. But this is the point, is the rest of it's my opinion, and maybe I'm wrong, but it's my opinion that the big majority of people who think that the dollar is going to zero are Americans. And they're kind of these self-loathing Americans who think that the US has lost its way. which I will agree with, and I'm disappointed in the arc of history with what's going on as well. But they don't realize that it's even though we are not where we once were, people from other parts of the world still have it worse than we do, right?
Yeah.
We kind of have the luxury of hating ourselves. In other words, we have it so good, we have the luxury of thinking how bad it is. But there's a video going around. I should find it and send it to you. And it basically talks about what you were just talking about. And it goes to countries like Turkey and Egypt and Argentina. And it's, it talks about these people who have lived through high levels of inflation. And so what do you do? How do you fight against it? And literally they all say, as soon as we get money, we go buy dollars. And then somebody in another country, we go buy dollars. And again, you don't have to like it, but just understand that, it's the common knowledge game, right? It's when you have in the common knowledge game, you're not supposed to vote for what you like the best. You're supposed to vote for what you think everybody else likes best. And I think this is going to continue to happen. Again, Japan is not going to be able to have the yen appreciably without sacrificing their bond market. If they sacrifice their bond market, then their banks, their insurance companies, their pension funds all fail. It's like, I'll use Luke as an example here because I get asked about him all the time. And Luke does a very good job of explaning the challenges that the US has.
And I want to play
right?
devil's advocate next, because I think I understand Luke's and Peter's position. So I want to I'll play devil's advocate next topic here.
Well, so I mean, the point that those two gentlemen will make is that the U.S., we've got the twin deficits. We can't let interest rates rise appreciably because we can't afford it. We have so much debt. If interest rates even go up 1%, that means the interest rate is now over $1 trillion a year, et cetera. And I get it. That's absolutely true. But it's even more true for these other countries. And these other countries are already in that situation, which we are not yet in. So again, on a relative basis, I believe that there is going to be a progression and an order in which the dominoes fall. Yeah. I am not going to say that the US domino will not fall. I think the US domino will eventually fall. I think all these other dominoes fall first. And I think, listen, I can be wrong. I've tried to say this in every interview I ever give. I'm pretty confident. I'm pretty stubborn. That's a result of being the son of Bruce Johnson. That's just the way it is. But if I'm wrong, I will admit I'm wrong. There's no guarantee that I'm right. I think I'm right, but I could be wrong. But I haven't seen any evidence that those others that we are going to fall before those others. But I've seen a lot of evidence that those others are going to fall before us.
Yeah. Do you think there's an argument for us, the United States, having a better transfer mechanism to get those dollars or newly created currency units outside of the country and circulating in the global FX market to bring down the level of that currency? So in other words, it is true that Japan is going to have to, let's say, print a ton of money, but they're running a trade surplus. So therefore it's tough for those those excess yen to get outside of the country to really affect the yen against the dollar, where our trade deficit is getting higher and higher and higher and higher and higher. Therefore, that's a transfer mechanism to get all of those newly printed dollars that we're going to have to print to fund Social Security and all these, and Medicare and all the unfunded liabilities that Luke would mention. We've already got that fire hose, if you will, spraying the world with dollars. So is it just that the global dollar denominated debt is just so massive that it can absorb any type of fire hose of dollars that we can provide, even if our budget deficits are going from 5 trillion to 10 trillion to 15 trillion to 20 trillion dollars?
I would argue that it's the latter.
Yeah.
And this is the thing, the system will get bigger until it collapses. And that's why I say the dollar will keep going higher. The more they print, the higher the DXY will ultimately go. Because the more the Fed prints, the more Japan's going to have to print. The more Europe's going to have to print. The more China's going to have to print. and it just keep boom, the bubble just gets bigger. Now eventually it will collapse, right? But there is so much demand for dollars in the euro dollar market,
right,
that we can get away with printing a lot more than the rest of the world. Again, if you look at those charts that show how much they printed or how much QE they did versus the Fed balance sheet or versus each central bank balance sheet, right? And in that, the Fed is lower than its peers. But if you actually use the denominator of the euro dollar market rather than just the domestic US dollar market, it becomes even lower than everybody else. So in other words, like the denominator that is used in those charts when looking at the dollar is, in my opinion, incorrect. The denominator is actually much bigger than that because of the euro dollar market, which nobody can measure. Anyway, this is,
and you're looking at the supply, basically, guys, Brent's talking about, you're looking at the supply demand equation for dollars domestically when it's the global currency. So you're just looking at a very small fraction of the overall pie.
Right.